Okay, let's unpack this. We're diving deep today into a new type of asset that has, well, truly captured global attention. It's really challenging traditional finance and sparking some incredibly intense debate.
Yeah, absolutely. It's digital, secured by code, and, in many cases, it operates without needing central authorities like banks or governments. A big shift.
It is, and it's a space that can feel, frankly, overwhelming at first glance, filled with complex tech, rapid changes, and those headline-grabbing price swings.
Definitely. But our goal here in this deep dive, using the comprehensive source material you've provided, is to kind of move beyond the jargon and the hype.
Right.
We want to get to the fundamentals. What is this stuff, really? How does it actually function, under the hood? And importantly, what gives these digital assets their value? That's the big question for many.
Exactly. Think of this as your shortcut to being genuinely well-informed on this dynamic and, let's be honest, often experimental frontier.
And right off the bat, the source material points out something quite important. The term cryptocurrency itself might be a bit limiting these days.
Yeah, that's a crucial insight. Well, the early ones like Bitcoin were conceived as peer-to-peer digital cash. The whole ecosystem has just exploded since then.
So it's much broader now.
Oh, definitely. We're looking at far more than just digital money for payments. The space now covers a really diverse range of digital tokens.
Like what, for example?
Well, you have utility tokens, which are designed basically to give you access to a service or a platform within some decentralized system.
Okay.
Then there are governance tokens. These give holders voting rights, essentially a say in how a project develops or changes its rules.
Right, so influence over the protocol.
Precisely.
Right.
And of course, you have NFTs, non-fungible tokens. These represent unique items, digital or even physical sometimes. They enable things like proving digital ownership, provenance, that kind of thing.
So it's clearly not just about creating a new form of cash anymore. It sounds more like building entirely new digital economies and, well, structures.
That's a great way to put it. And the source material really hammers home the rapid innovation here. And yes, the experimental nature of it all. Things aren't set in stone. They're constantly being built, tested, refined.
That constant evolution must be part of the excitement, but also the challenge, right?
Absolutely. Challenges around scaling, security, making it user-friendly, regulatory clarity. These are things the industry is actively wrestling with. New solutions, new protocols pop up all the time.
So what we discussed today is a snapshot.
Pretty much. We'll provide a solid foundation based on the sources, but you have to appreciate this space is a moving target. What's cutting edge today might be standard tomorrow or, maybe even obsolete.
Right. Okay, so to really get a handle on this, where do we start with the mechanics? How does it all actually work?
Well, we begin with the core definition, but keeping in mind that broader context. Cryptocurrencies are essentially digital or virtual tokens. They use cryptography, that's complex math, and coding for security.
Security for what exactly?
For securing transactions, controlling how new units are made, and verifying the transfer of assets, all typically without needing a central middleman. The idea is often peer-to-peer transactions online, bypassing banks.
So the key differentiator is that decentralized operation. No single entity in charge, like a central bank.
Precisely. And that's a massive difference compared to fiat currencies, like the dollar or the euro.
How so?
Fiat is issued and backed by a government. It's declared legal tender, and its value is tied to the stability of that government and economy managed by a central bank.
Right.
Most cryptocurrencies, as the sources point out, don't have that government decree or physical backing. Their value is mostly determined by market forces, supply and demand within their own network.
I remember seeing in the sources that some institutions, like the Reserve Bank of Australia, have questioned whether many cryptos actually count as money in the traditional sense. Why that distinction?
Yeah, their perspective, as highlighted in the material, is that while they can function as a medium of exchange in some situations, they often fall short on other traditional criteria for many.
Such as?
Well, they aren't widely accepted for everyday payments in most places, not like fiat. And crucially, their high price volatility means they don't consistently act as a stable store of value. Stability is pretty key for traditional money.
Okay, so the value isn't guaranteed by a state. It's derived from something else.
Exactly. And we'll definitely dig into this value question later, but it comes from things like program scarcity, their actual usefulness in digital applications, and the network effects they build up.
So it's important to distinguish between being a useful digital token and meeting the full definition of money.
Yeah, that distinction is key to understanding where they are right now evolution-wise. There are tools for new kinds of value transfer and interaction, but that volatility means most people aren't using them as a stable unit of account or a reliable place to park their savings just yet.
And how do central bank digital currencies, CBDCs, fit in? They sound similar, being digital, but they're fundamentally different, right?
Fundamentally different, yes. CBDCs are basically digital versions of existing fiat currency issued and controlled by a central bank. They aim to blend digital efficiency with the stability and backing of traditional fiat.
So part of the existing system.
Exactly. They're a digital expression of the current financial system. Decentralized cryptocurrencies, on the other hand, are generally designed as an alternative to that system, operating outside its traditional structure.
Got it. Okay, so the core technology underpinning most of these is distributed ledger technology, or DLT.
That's right. DLT is the foundation. Think of it simply as a database, but one that's replicated, shared, and synchronized across a whole network of computers or nodes.
So no single central copy.
Exactly. It removes that single point of control or storage. It's like a shared spreadsheet that everyone on the network has an identical, constantly updated copy of.
And everyone has the same record. That sounds important.
It is. This distribution is key. The sources highlight several advantages. Decentralization, meaning no single point of failure or censorship. Immutability, which makes it incredibly hard to change or delete records once they're added.
Hard to tamper with.
Very. Also security, using cryptography to make it tamper-resistant. And transparency, where transactions are generally visible to participants, though the level of visibility depends on if it's a public or private ledger.
And blockchain is the most well-known type of DLT.
Yes, it's the type that Bitcoin famously introduced. A blockchain is a specific kind of DLT where data is grouped into blocks.
Okay.
These blocks are then linked together in chronological order using cryptography, forming a chain. Each block contains a batch of transactions, a timestamp, and crucially, a cryptographic hash of the previous block.
That hash again. How does that link provide security?
Right. The hash acts like a unique digital fingerprint for the data in a block. Because each new block contains the hash of the one before it, they're chained together in a way that's tamper-evident.
How so?
If someone tries to alter data in an older block, its hash would completely change. Since the next block contains the original hash, the link is broken. It's immediately obvious to the entire network that something's wrong.
So you'd have to recalculate everything afterward.
Exactly. You'd have to redo the altered block and every single block that came after it, recalculating all their hashes. On a large, active network that's computationally almost impossible. That's what makes the blockchain effectively immutable.
How does that compare to a normal database, say, at a company?
Well, traditional databases are centralized. An administrator controls them and can easily modify or delete records. Blockchains, being distributed, need network consensus agreement among participants to add new data.
And errors aren't just deleted.
Right. If there's an error, you don't erase the mistake. You add a new transaction that corrects it, leaving both visible. This whole structure builds trust in the data itself without needing to trust a central administrator.
But that immutability has downsides too, right? The source material mentioned challenges.
It does. If a mistaken or fraudulent transaction gets confirmed and added, reversing it is extremely difficult, often impossible. There's no undo button or customer support line like a bank. Users really have to be careful.
And what about transparency versus privacy? Does everyone see my name?
Usually not your name directly. On public blockchains like Bitcoin or Ethereum, the transaction data amounts, timestamps, wallet addresses is visible, but the addresses are pseudonymous.
The meaning.
There are long strings of letters and numbers not directly tied to your real-world identity unless you somehow link them publicly, perhaps through an exchange account. It gives some privacy.
But it's not fully anonymous.
No. And the sources point out that advanced blockchain analysis tools are getting better at potentially de-anonymizing users by tracking patterns or linking addresses to known entities. This is a big area of concern for regulators looking at illicit finance.
So transparency of transactions, but pseudonymity, which can potentially be compromised.
Precisely. And another important nuance from the sources. The actual degree of decentralization isn't uniform across all networks.
How does that vary?
It depends on things like how many nodes are running the software, how concentrated the mining or staking power is, and how decisions about the network's future governance are made. This impacts how resilient and censorship-resistant a network truly is.
Okay, so we have the digital tokens, the distributed ledger, the chain of hashes securing it. But the fundamental security, proving ownership, ensuring authenticity, that's where cryptography gets even deeper, right?
Absolutely.
Sure.
Cryptography is the bedrock. It provides confidentiality, integrity, authenticity, and non-repudiation, basically, ensuring things are secure and trustworthy without a central overseer.
You mentioned hashing links the blocks. What else does it do?
Well, beyond linking blocks, hashing ensures data integrity within blocks, acts like a fingerprint to detect tampering, and helps create unique IDs for transactions. But another huge piece is public key cryptography.
Also called asymmetric cryptography.
Right. It uses a pair of mathematically linked keys, a public key and a private key.
And the public key is for sharing.
Exactly. You can share your public key freely. It's used to generate your wallet address. That's where people send crypto to you. Think of it like your bank account number or IBAN.
And the private key, that's the secret sauce.
That's the crown jewels. You must keep your private key secret. It's what you use to authorize transactions from your wallet. When you want to send crypto, your wallet software uses your private key to create a digital signature.
Proving it's really you sending it.
Precisely. It proves you own the funds without you ever needing to reveal the private key itself. Control the private key, control funds. It's that simple and that critical.
So how does that digital signature work to prove things?
When you sign a transaction, your private key essentially encrypts a hash, a summary of the transaction details. Anyone else can then use your public key to decrypt that signature.
Okay.
If the decrypted hash matches the hash they calculate themselves from the transaction data, they know it's authentic, came from the owner of the public key, has integrity, wasn't altered, and you can't deny sending it, non-repudiation.
So that's the trust in math, replacing trust in, say, a bank teller.
Exactly. These cryptographic methods enable secure operations without a central authority. They secure your wallet and make the ledger immutable. And, as the sources stress repeatedly, protecting your private key is your responsibility.
A huge difference from banking.
Massive. If you lose your private key or it gets stolen, your crypto is usually gone for good.
Yeah.
No bank to appeal to, no fraud department to reverse the charge in most cases.
Right, a fundamental shift in who bears the risk and responsibility. Any other cryptographic wrinkles?
Well, that transparency-pseudonymity tension is a direct result of how public key crypto is used on public ledgers. And looking further out, some sources mention the theoretical sweat from quantum computing.
Quantum computers could break current encryption.
In theory, yes. Future powerful quantum computers might be able to break the cryptographic standards used today. This would require networks to upgrade to new quantum-resistant algorithms eventually. It's a long-term concern researchers are already working on.
Fascinating. Okay, so we've got the components. Tokens, DLT, cryptography. Let's put it all together. How does a transaction actually happen, step by step, when I want to send some crypto?
Okay, let's walk through it. Starts with initiation. You, the sender, use your wallet software. That's what holds or manages your private keys.
Right.
You put in the recipient's address, which comes from their public key, and the amount you want to send. Your wallet then creates the transaction message and digitally signs it using your private key.
So I've authorized it cryptographically. What next?
Next is broadcasting. Your signed transaction isn't sent directly to the recipient. It's broadcast out to the cryptocurrencies peer-to-peer network. All those computers running the software globally.
Like shouting it out to the network.
Kind of, yeah. Nodes receive it, do a basic check on the signature and format, and then pass it along to other nodes they're connected to. It spreads through the network.
Okay, then it waits somewhere.
Usually, yes. It lands in a pool of unconfirmed transactions, often called the mempool, waiting to be included in a block. Now comes verification and block creation.
Who does that?
This is done by specific nodes participating in the consensus process. In proof of work, these are miners. In proof of stake, they're validators. They grab transactions from the mempool.
And they double-check everything.
They do. They verify the digital signature using your public key. Is it authentic? Has it been tampered with? Crucially, they check your wallet balance on the ledger to make sure you actually have enough funds to send. This prevents double spending.
Right. Can't spend the same coin twice.
Exactly. Validated transactions are then bundled together into a new block. This block also includes the hash of the previous block, linking it into the chain, and usually a timestamp. Often, transactions offering higher fees get picked first as an incentive.
Oh, okay. The block is built. How does it get officially added to the blockchain? This seems like the key step.
It is. This is the consensus phase. The network needs to agree that this new block is valid and should be the next one added. How they agree depends on the consensus mechanism.
Like proof of work.
Right. In proof of work, PODO, like Bitcoin, miners compete to solve a very difficult cryptographic puzzle tied to the block data. It requires immense computing power and energy. It's a race.
And the winner.
The first miner to find the solution broadcasts their completed block, including the puzzle solution, to the network. If the network nodes verify it's correct, that block gets added, and the successful miner earns a reward, newly minted coins, plus the transaction fees from that block.
And proof of stake, PSS.
In POS, like Ethereum now uses, validators are chosen to propose or attest to new blocks, often based on the amount of crypto they've staked or locked up as collateral. They vote on blocks. If they act honestly, they get rewarded, usually fees or new coins. If they try to cheat, their staked collateral can be slashed or destroyed. POS is designed to be vastly more energy efficient.
So once a valid block is created and proposed through either POW or POS,
It's broadcast to all the other nodes. They independently verify it. Is the POW solution correct? Are the transactions valid? Does it correctly linked to the previous block? If a majority of the network agrees it's valid according to the rules, they add it to their own copy of the blockchain. That's consensus.
and my transaction is complete.
Yes. Once the block containing your transaction is accepted and added to the chain, your transaction is considered confirmed. The recipient's wallet balance updates, and the transaction becomes more secure as more blocks get added on top of it, making it exponentially harder to undo later.
That whole process, especially the proof of work part, sounds like it really highlights that tension between security, decentralization, and speed, the blockchain trilemma you mentioned.
Directly. The blockchain trilemma describes how hard it is to optimize for decentralization, security, and scalability, speed and transaction volume, all at once. POW heavily prioritizes security and decentralization through that computationally intensive work, but that often comes at the cost of speed and throughput, impacting scalability. Reaching global consensus just takes time and resources.
And that's why transaction fees can spike when the network is busy.
Exactly. Fees often work like an option for limited block space. When demand is high, users offer higher fees to get their transactions included faster. This can make small payments uneconomical, which challenges the narrative of crypto always being cheap.
What about finality? In my bank account, once a transfer shows up, it's final. Is crypto the same?
It's a bit different, especially in POW systems. POW finality is often called probabilistic. While a transaction is confirmed in a block, there's a tiny theoretical chance the chain could be reorganized if someone built a longer, valid chain starting from an earlier block. This gets vanishingly small with more confirmations, but it's not instant absolute finality. Some POS systems aim for faster, deterministic finality, where after a certain point, a transaction is truly irreversible. This difference matters for financial applications needing immediate settlement certainty.
Right. Okay. That clarifies the mechanics really well.
Yeah.
So we know how transactions get confirmed and blocks get added, but where do the actual coins or tokens come from in the first place? How is new crypto created?
Good question. New units are typically introduced, and networks are secured and maintained through specific mechanisms defined in their protocols. The two most dominant methods are mining, linked to proof of work, and staking, linked to proof of stake.
Let's start with mining and proof of work again.
Okay. As we saw with transactions, POW uses computational power, the work, to secure the network and validate transactions. Miners use specialized hardware, often ASICs for Bitcoin, or powerful GPUs for others to churn through calculations.
Trying to solve that puzzle.
Exactly. They're essentially guessing trillions of numbers per second, trying to find a specific value, a nonce, that when combined and hashed with the block's data, produces a result that meets a certain difficulty target set by the network.
And the first one to find it wins the prize.
Yes. The first miner to find a valid solution gets to propose their block of transactions. If the network accepts it, they receive the block reward, a set amount of newly created cryptocurrency, plus all the transaction fees from the transactions included in that block.
So the block reward is the main source of new coins for things like Bitcoin.
Primarily, yes. For POW coins like Bitcoin, Litecoin, Dogecoin, that's how new supply enters circulation. Mining does double duty. It processes transactions and crucially secures the network. The sheer cost in hardware and energy makes it prohibitively expensive for attackers to try and overpower the network, like attempting a 51% attack.
But as we touched on, mining gets heavily criticized for its environmental impact.
It's a major, major concern highlighted repeatedly in the source material. That intense computational race consumes enormous amounts of electricity.
Any examples?
Yeah, one study cited found that just a handful of major U.S. Bitcoin mines use more power than the entire city of Los Angeles over a period. Another analysis linked the carbon footprint from fossil fuel-powered mining to significant climate and health damages per dollar of Bitcoin value created. Some sources even use stark terms like digital crude to describe it.
Digital crude. Wow, that really paints a picture.
It does. It underscores the scale. Beyond energy, there are other challenges. The high cost of specialized mining rigs acts as a barrier to entry for individuals, and there are concerns about mining power concentrating in large pools or regions with cheap electricity, which potentially undermines decentralization.
And proof of stake, POS, is positioned as the answer to that energy problem.
Largely, yes. That's its main selling point compared to PW. Instead of burning electricity in a computational race, participants in POS systems, called validators, lock up or stake their own cryptocurrency as collateral.
So they have skin in the game.
Exactly. Validators are chosen to propose or attest to new blocks, usually based on the size of their stake, often with some randomness mixed in. If they propose valid blocks and follow the rules, they earn rewards, typically transaction fees, sometimes newly issued coins.
And if they cheat?
That's where the slashing comes in. If a validator tries to double sign, propose invalid blocks, or attack the network, a portion or potentially all of their staked collateral can be confiscated and destroyed by the protocol.
So security comes from economic incentives and disincentives, rather than raw computing power.
Precisely. It incentivizes good behavior with rewards and punishes bad behavior with the threat of losing significant capital. PS validators still validate transactions and secure the network, and the rewards contribute to the coin supply dynamics.
And major examples of PS coins.
Ethereum is the big one now, after the merge. Others include Cardano, Solana, Polkadot. Many newer blockchains use PS from the start.
What are the main advantages claimed for POS besides the huge energy savings?
The sources highlight lower barriers to entry. You need capital to stake, but not necessarily expensive, specialized hardware like miners. This can potentially lead to wider participation. POS is also generally considered to enable better scalability, allowing for faster transaction speeds and higher throughput compared to many payout chains.
Does PS have its own set of challenges or criticisms?
It does. One concern is potential centralization, the rich get richer problem, where those with large stakes might gain disproportionate influence over the network. There was an early theoretical issue called the nothing at stake problem, but modern POS designs with slashing aim to solve that. And while it's gaining ground fast, particularly with Ethereum's move, POS is still newer than POW. So some argue it has a shorter track record in terms of proven security under attack, though this perception is evolving.
And people can participate in staking in different ways.
Yes. The sources mention several options. You can run your own validator node if you have the technical skills and sufficient stake. You can delegate your stake to a professional validator service. You can join staking pools to combine funds with others. Many centralized exchanges offer staking services. And there's liquid staking, where you get a derivative token representing your staked assets, which you can then use in other DeFi applications while still earning rewards.
So the shift from POW to POS isn't just technical, it's almost philosophical, about how security is achieved and where power lies.
That's a really insightful point that comes through in the sources. PW security is kind of external, tied to real-world energy and hardware costs. POW security is internal, tied to the economic value locked within the system. This changes the dynamics. POW power can centralize geographically around cheap energy. POS power can centralize around wealth accumulation within the network. Both have centralization risks, just different kinds.
Okay, beyond mining and staking for established coins, how do new coins or tokens get created and distributed, especially when a project is just starting?
Right. For new projects launching their own tokens, several methods have become common. Early on, initial coin offerings, ICOs, were huge.
How do those work?
A project would basically create its new token and sell it directly to the public, usually asking for payment in established cryptos like Bitcoin or Ethereum, sometimes even fiat. They'd release a white paper outlining their plan, tech, and the token's economics, its purpose, supply, distribution, etc. Many early tokens launched on platforms like Ethereum using standards like ERC-20.
ICOs got a bit of a wild reputation, though, didn't they?
They certainly did. The source material highlights the almost complete lack of regulation around early ICOs, which unfortunately led to many scams and projects that just disappeared with investors' money. But it's also true that ICOs were a genuinely new and powerful way for legitimate projects to raise capital and build a community without going through traditional venture capital gatekeepers.
And that led to refinements like IEOs and IDOs.
Exactly. As a response to the risks, initial exchange offerings, IEOs, emerged. Here, the token sale happens on a centralized cryptocurrency exchange. The exchange usually does some level of vetting or due diligence on the project beforehand, which adds a layer of credibility. Plus, the token typically gets listed on that exchange soon after, providing instant liquidity.
Okay, a bit more structured. And IDOs.
Initial DEX offerings, IDOs, are similar, but they take place on decentralized exchanges, DEXs. These tend to be more community-driven and permissionless. They also offer immediate listing and liquidity, but on the DEX itself.
So, this evolution reflects the market trying to find better ways to launch tokens.
Yeah, that's a key takeaway. From the wild west of ICOs to exchange-vetted IEOs and decentralized IDOs, you see the market trying to balance innovation and fundraising accessibility with the need for investor protection and legitimacy, often moving faster than formal regulations can keep up.
Are there other, more technical ways new crypto assets come into being?
Yes. One way is forking. This involves taking the existing code of a blockchain, modifying it, and creating a split. One path continues the original chain, the other starts a new chain based on the modified code. Bitcoin Cash, for instance, was created via a hard fork of Bitcoin.
Okay.
Then there's building an entirely new blockchain and native cryptocurrency from the ground up. This is the most complex route, requiring deep expertise and resources, but offers maximum flexibility. Bitcoin itself and the original Ethereum network are examples.
And creating tokens on existing chains.
That's become extremely common. You can create new tokens on existing blockchains like Ethereum, Solana, Avalanche, etc., using established standards like ERC20. This leverages the security and infrastructure of the host blockchain, making it much easier for developers to launch tokens tied to their specific applications or projects.
And fundamentally, the way a coin or token is created and distributed defines its economic model, its tokenomics.
Absolutely. The chosen mechanism, POW mining with halving, POS staking rewards, and an ICO distribution, etc., is central to the tokenomics. It dictates the supply schedule. Is it fixed like Bitcoin or inflationary? How it gets into people's hands, whether and it gets burned or removed from circulation, what drives demand for it, and the incentives for everyone involved.
So understanding tokenomics is crucial for judging a project's viability.
Critically important. It shapes the incentives for users, developers, miners, validators. If the tokenomics are poorly designed, maybe hyperinflationary with no real demand or overly concentrated in a few hands, it can doom a project no matter how clever the technology is. It's a core part of assessing any crypto asset's potential.
Okay, that makes sense. We've really covered the how and where from. Now let's shift focus to the why it matters. The source material talks a lot about the potential for this technology to fundamentally reshape global finance. How is that envisioned?
Well, the core idea is that crypto challenges the traditional financial system, which is heavily centralized and relies on many intermediaries.
You mean controlled by central banks, governments, with banks and payment companies in the middle of everything?
Precisely. Fiat money is state-controlled. Transactions go through layers of banks, clearinghouses, payment networks like Visa or SWIFT. Decentralized cryptocurrencies aim to cut through that. They operate on peer-to-peer networks, distributing control, making them potentially more resilient to single points of failure or censorship. Bitcoin itself emerged right after the 2008 crisis, explicitly designed as a way to transfer value without trusting banks.
And this leads to the idea of disintermediation, cutting out the middleman.
Yes, enabling direct peer-to-peer interactions without needing those traditional financial institutions. This is most starkly seen in decentralized finance, or DeFi, which we'll get into.
So the really big implication is, could banks become less central to finance?
That's the potential disruptive power, yes. If decentralized crypto and DeFi gain mass adoption and regulatory acceptance, they could significantly reduce the role of traditional banks, potentially offering users more transparency, direct control over assets, and perhaps greater security in some aspects. The sources suggest this push comes not just from the tech, but also from a desire for alternatives after financial crises, a wish for more financial autonomy, and building more resilient systems.
But the sources also flag new kinds of risks for financial stability, don't they?
Oh, absolutely. Regulators are definitely watching closely. The material cites concerns like information asymmetry, basically, insiders knowing more than outsiders in these new markets, market inefficiencies, the risk of cryptoization in some countries.
What's that exactly?
That's where people in a country with, say, very high inflation or an unstable currency start bypassing it and using a foreign cryptocurrency instead, like Bitcoin or stablecoin. This can undermine the country's own monetary policy. Other big concerns are the high volatility and the growing links between crypto markets and traditional finance, which could transmit shocks.
And it's interesting, despite the goal of cutting out intermediaries, new ones seem to be popping up in the crypto world itself.
That's a really important nuance the sources point out. You might bypass your traditional bank, but you often end up using new intermediaries. Centralized exchanges like Binance or Coinbase, companies providing crypto wallets, the teams developing DeFi protocols, specialized custodians storing crypto for institutions. They're different, but they can reintroduce centralization, single points of failure, or vulnerabilities, think exchange hacks or DeFi protocol exploits. So intermediation is changing form, not necessarily vanishing.
And the fact these markets run 24/7 globally adds another layer of complexity.
Yes. Risks can spread incredibly fast, across borders, outside traditional market hours. This makes monitoring and coordinating responses much harder for regulators.
Okay, one of the most talked about potential uses is revolutionizing payments, especially cross-border ones, remittances. Why is that seen as such a prime use case?
Because the traditional way of sending money internationally is often, frankly, terrible. It's slow, can take days, it's expensive, multiple banks take a cut, there are SWIFT fees, currency conversion markups. It's just inefficient.
And crypto offers a better way.
That's the promise, using blockchain. The key advantages are typically speed. Transactions can potentially settle in minutes or even seconds, and the networks run 247. Costs generally lower fees by cutting out many intermediaries. While fees on networks like Bitcoin can get high when congested, many other blockchains or Layer 2 solutions offer very low fees.
How much lower?
The sources suggest crypto remittance fees can often be in the 2–5% range, sometimes lower, compared to traditional averages that can easily be 6–12% or more. That's a huge saving for people sending money home to family.
It really is. Any other advantages?
Well, the decentralized nature potentially means less reliance on any single institution's approval, offering more censorship resistance. And public ledgers provide a degree of transparency about the transaction flow.
Are there real-world examples showing this works?
Yes, the sources give some good ones. Bitso, a platform in Latin America, reportedly handles billions in remittances between the US and Mexico, with fees often under 1%. In Venezuela, facing hyperinflation, crypto is increasingly used for remittances, maybe around 10% of the total $5 billion in 2023, and also as a way for people to try and preserve value. Even humanitarian aid, the UNHCR used the stablecoin USDC to deliver aid efficiently to displaced people in Ukraine.
Using stablecoins makes sense. There avoids the price swings of the recipient.
Exactly. Stablecoins are becoming very popular for remittances precisely because they minimize that volatility risk. The recipient gets something much closer to the value that was sent.
But what are the hurdles stopping crypto from becoming the standard for payments?
Several big ones remain. Price volatility for non-stable coins is still a major issue. Regulatory uncertainty in many countries makes businesses and individuals hesitant. User experience can be tricky. Managing keys, addresses, understanding fees isn't always intuitive. And then there's the last mile problem.
Meaning getting the crypto back into local cash.
Right. How easily and cheaply can the recipient convert the crypto into their local currency to actually spend it? This often involves local exchanges or services that might have their own fees, liquidity issues, or user challenges, potentially eroding the initial savings.
And stablecoins themselves face scrutiny, right, over their backing.
They do. Because they're pegged to fiat currencies, regulators are increasingly focused on ensuring they have adequate, verifiable reserves to maintain that peg, especially the larger ones that could pose systemic risks if they failed.
But overall, the pressure from crypto is forcing traditional payment providers to improve.
The sources suggest that yes, this competition is likely pushing traditional players to lower costs and innovate, which could benefit consumers overall.
Another huge potential impact often discussed is financial inclusion reaching the unbanked. How can crypto help people who are currently excluded from the financial system?
It's a massive issue globally. The World Bank figures suggest around 1.7 billion adults lack access to formal financial services. Barriers include high fees, lack of required ID documents, living too far from a bank branch, or simply distrusting the institutions. Crypto offers ways around some of these.
Like distance not being an issue.
Exactly. It's digital, peer-to-peer. You just need a smartphone and internet, potentially bypassing the need for physical banks, which is huge in remote areas. It can also lower costs by cutting intermediaries. And often, setting up a basic crypto wallet has lower KYC requirements than opening a full bank account.
So it empowers people without bank accounts.
Potentially, yes. It allows them to participate in the digital economy, send, receive payments, maybe store value, without needing that traditional relationship. We see this happening already in regions like Sub-Saharan Africa and Southeast Asia with high mobile penetration, and in countries like Nigeria or Venezuela, where people use it for remittances or as a hedge against very unstable local currencies.
Can it offer more than just basic payments?
The potential is there, especially with DeFi. Platforms could allow the unbanked to earn interest on savings or borrow using crypto as collateral, things usually requiring a bank account and credit history. Also, the divisibility of crypto and low fees on some networks make micropayments feasible, which is important in many developing economies.
Any specific examples of inclusion efforts mentioned?
Beyond the remittance examples, the sources touch on initiatives trying to integrate crypto wallets with existing mobile money platforms, which are already widespread in places like Africa. This could bridge the gap for many users.
But what are the main roadblocks to crypto actually delivering on this promise of inclusion?
There are quite a few significant challenges. Digital and financial literacy is a big one. People need education and easy-to-use tools. Regulatory uncertainty creates risk and hinders the development of reliable on-ramps and off-ramps to local currency. You still need reliable internet and affordable smartphones. Price volatility is a huge risk for low-income users. Security is another major concern. Less tech-savvy users are more vulnerable to scams and hacks, and there's no safety net like deposit insurance. And DeFi, while powerful, is often too complex for beginners right now.
And that risk of cryptoization comes up again here too.
Yes, the macroeconomic concern. If everyone bypasses the local currency, it can destabilize the national economy and undermine monetary policy. Real, sustainable financial inclusion probably needs more than just letting people use foreign crypto. It requires building robust local ecosystems, easy links to local currency, and products designed for local needs.
Okay, let's really dive into decentralized finance, DeFi. You've mentioned it a few times. This seems to be where a lot of the really cutting-edge financial innovation is happening. What exactly is DeFi?
Right. DeFi is basically an ecosystem of financial applications built on blockchains, mostly Ethereum historically, but now expanding to others. The core aim is to recreate traditional financial services. Think lending, borrowing, trading, insurance, but without the central intermediaries. No banks, no brokers, no insurance companies in the middle.
And how does it achieve that?
It relies heavily on smart contracts. These are pieces of code deployed on the blockchain that automatically execute the terms of an agreement once certain conditions are met. They automate processes, enforce rules, and handle funds according to the pre-written logic.
So finance run by code instead of by committees and banks.
That's the vision, yes. DeFi leverages these smart contracts for automation, transparency — the code and transactions are usually public on the blockchain — and permissionless interaction, meaning, in theory, anyone with a crypto wallet and internet can connect and use these services without needing approval.
What are the main building blocks of this DeFi world?
The sources often describe it in layers. You have the base settlement layer, the blockchain itself, like Ethereum, providing security. Then the asset layer, the crypto assets used, like ETH, stablecoins, or other tokens. The protocol layer is where the smart contracts live, defining specific activities.
Like what kind of activities?
This includes protocols for decentralized exchanges, DEXs, like Uniswap or Curve. These often use automated market makers, AMMs, instead of traditional order books, allowing users to trade directly against pools of liquidity provided by other users. You also have lending and borrowing protocols like Aave or Compound, where you can deposit crypto to earn interest, or borrow crypto by putting up other crypto as collateral. There are protocols for derivatives, insurance, asset management, replicating much of traditional finance.
And then user-friendly interfaces on top.
Exactly. The application layer is the user-facing apps or websites, dApps, that let people interact with these protocols. And sometimes an aggregation layer that pulls data from multiple protocols to offer users the best rates or execute complex strategies simply.
What makes DeFi potentially so transformative, according to the sources?
Several things. Efficiency automation can reduce costs and speed up settlement compared to manual, intermediary-heavy processes. Transparency, the rules and transactions are generally on a public ledger for anyone to inspect. Accessibility potentially opens up financial services globally to anyone with internet, tying back to that inclusion idea. And innovation, the open source, composable nature, means developers can easily build new products by combining existing DeFi protocols like money Legos.
And it's grown incredibly fast.
Phenomenally fast. The source material often points to the explosive growth in total value locked, TVL, the amount of assets users have deposited into DeFi protocols reaching billions and projected to grow much further. It shows real demand for these alternatives.
But DeFi is also notoriously risky, right? What are the main challenges?
Critically risky, yes. Security vulnerabilities are a huge issue. Smart contracts are just code, and bugs or design flaws can be exploited by hackers. We've seen massive losses from things like flash loan attacks, re-entrancy bugs, and especially hacks of cross-chain bridges that connect different blockchains. The interconnectedness also creates systemic risk. A problem in one major protocol could potentially cascade and cause failures elsewhere.
Regulation must be a big cloud hanging over DeFi, too.
A massive one. DeFi operates in a very gray regulatory area globally. Governments are struggling with how to apply existing financial rules to these novel, often pseudonymous, and automated systems. There's a push towards requiring KYC/ML checks on the front-end applications that access DeFi, which kind of clashes with the original permissionless ethos.
And technical limitations.
Scalability is still a bottleneck for many DeFi applications running on congested blockchains. High gas fees can make simple actions prohibitively expensive. Layer 2 scaling solutions are vital here. Governance is another challenge. How do you securely and fairly manage and upgrade these decentralized protocols, often through voting by token holders? And user experience is still a major hurdle. Using DeFi involves managing keys, understanding gas, interacting with complex protocols, and assessing risks. It's much harder than using your online bank account.
So huge potential, but definitely still in its early, risky, and complicated stages. What does the future look like for DeFi?
The sources suggest continued rapid innovation and likely more integration. Things like potentially using AI or machine learning within protocols for better risk management or automation. A big focus is on improving cross-chain interoperability so value can move easily between different blockchains. Developing decentralized identity solutions could help bridge the gap between anonymity and the need for verified identities in some financial contexts.
It really does feel like the experimental edge of crypto finance.
It absolutely embodies that vision of a completely decentralized financial system, but it's one that's still very much under construction, facing significant practical hurdles and a looming regulatory reckoning.
Okay, let's tackle maybe the biggest question of all, the one that sparks endless debate. What actually gives cryptocurrencies value? If they aren't backed by gold or a government promise, why is this digital code worth anything at all?
Right. This is the core enigma, isn't it? It's a new asset class, and trying to fit it into traditional valuation boxes is really difficult because, like you said, there's no physical backing, no company earnings stream, no government guarantee in the usual sense.
So just to contrast again, how does regular fiat money like the dollar get its value?
Well, fiat money is issued by a government, declared legal tender. Its value rests on trust in the stability of the issuing government and economy, and trust in the central bank's ability to manage the supply responsibly through monetary policy. It's top-down, regulated, uses intermediaries, and is generally aimed at relative stability, although inflation erodes its value over time.
And crypto is kind of the opposite in how value emerges.
In many ways, yes. Issuance is often set by a protocol, potentially decentralized, no direct backing. Value is driven by market dynamics. Supply can be fixed and scarce, like Bitcoin, or inflationary. It's purely digital, often peer-to-peer. Regulation is patchy and evolving, and volatility is often extremely high.
The sources mentioned a fundamental shift in the trust model. How does that relate to value?
That's a really key insight. Fiat value depends on institutional trust. You trust the Fed, the government. Decentralized crypto value depends on technological trust. You trust the cryptography, the consensus rules, the network's ongoing operation, and its adoption by users. It's a shift from trusting people and institutions to trusting math and distributed systems.
And yet, despite aiming for independence, their prices seem incredibly sensitive to government actions.
That's one of the fascinating paradoxes the sources highlight. Even with decentralized tech, news about regulations, potential bans, tax laws, these things can cause massive price swings. It shows the state still wields significant influence regardless of the underlying code.
So, given all that, what are the main theories or factors the sources identify that do contribute to crypto's market value?
Several key drivers come up consistently. The most basic is just supply and demand. The supply side is often predetermined by the protocol's code laid out in the white paper.
Like Bitcoin's fixed cap and halving.
Exactly. Bitcoin's hard cap of 21 million coins and its programmed halving events, which reduce the rate of new supply creation over time, create verifiable scarcity, often compared to gold. Plus, coins that get lost effectively reduce the supply further. Other cryptos might have inflationary models, maybe adding a fixed number of coins each year, which means they constantly need growing demand just to keep their price stable.
And the demand side seems incredibly complex.
It is. It's influenced by so many things. General market interest and sentiment, which can be swayed by news, social media hype, FOMO, FUD, the perceived utility or usefulness of the crypto, competition from other projects, adoption levels by individuals, businesses, institutions, and broader narratives, like whether people see it as a hedge against inflation or a bet on future technology.
And tokenomics ties into this directly.
Fundamentally, the whole economic design, the supply schedule, how tokens are distributed, if any are burned or removed, what drives demand, like needing it for fees, the incentives for participants shapes those supply and demand curves. It's critical for assessing long-term value. Bitcoin's scarcity, for instance, only matters if people actually want it.
Okay, supply-demand makes sense. What about utility value? Does the practical usefulness contribute to price?
Yes, utility is a major factor, referring to how it's used beyond just speculation. The most obvious is as a medium of exchange for payments, especially in those niches like cross-border or in unstable economies. The more places accept it, the more utility it has.
And for platforms like Ethereum, the utility is different.
Right. There, the utility comes from the platform itself being useful for building smart contracts and decentralized applications, DApps, things like DeFi, NFT marketplaces, blockchain games. The native token, like ZIF, is often required to pay for computations on the network, the gas fees.
So usage drives demand for the token.
Exactly. The more useful the Ethereum platform is, the more dApps get built and used, the more ETH is needed to pay for gas, which creates underlying demand supporting ETH's value. It's derived demand. Similarly, tokens issued by specific dApps often grant access to services within that app, tying their value to the app's utility and success.
But is there often a gap between current utility and speculative value?
Very often, yes. The sources caution that many crypto use cases are still early stage or niche. Speculative excitement can drive prices far beyond what current tangible utility might justify. That can be a warning sign. Long-term sustainable value likely needs that utility to catch up through broader adoption and genuinely useful applications.
You also mentioned network effects. How does that play into crypto valuation, maybe using Metcalfe's law?
Metcalfe's law is often brought up. The basic idea is that the value of a network increases exponentially proportionally to the square of its users. Applied to crypto, it suggests that as more people and entities start using a particular crypto, holding it, trading it, building on it, the network itself becomes more valuable.
Why more valuable?
More users mean more liquidity, potentially stronger security, especially in PFW, more potential partners for interaction, more incentive for developers to build apps, which attracts more users, creating a positive feedback loop. A vibrant ecosystem of dApps significantly boosts the network effects of the underlying blockchain, like Ethereum.
So user growth equals value growth.
It provides a framework suggesting a correlation, yes. It highlights why tracking community size, developer activity, and overall adoption is important for assessing a network's health and potential value.
Are there limitations to applying Metcalfe's law here?
The sources point out it's not a perfect analogy. It often assumes all users add equal value, but in crypto, active users or developers might contribute more than passive holders or speculators. It doesn't directly account for external shocks like regulation or tech breakthroughs that clearly impact price. And the exact mathematical relationship n squared is debated. You really need to look at multidimensional network effects, not just holders, but active users, developers, merchants, the whole ecosystem.
And can network effects work in reverse, pulling value down?
Absolutely. If users or developers start leaving a network, it can lose value rapidly, potentially triggering a death spiral, especially for newer projects. That's why metrics focused on active participation and actual usage volume are often more telling than just the total number of wallet addresses.
Okay, what about the really volatile drivers? Market sentiment, speculation, and macro influences, these seem to dominate the headlines.
They are huge, especially for short-term price movements. Market sentiment is just the overall mood, bullish or bearish. Positive news, maybe favorable regulation, a tech upgrade, a big company adopting it fuels optimism and buying. Negative news, a major hack, a regulatory crackdown, a project collapsing leads to fear and selling. Social media acts like a massive amplifier for both FOMO, fear of missing out, and FUD, fear, uncertainty, and doubt.
And pure speculation plays a big role, too.
A very significant role. A lot of trading is driven simply by trying to predict future price moves, not by any immediate need to use the crypto for its intended purpose. While speculation adds liquidity, it's also a primary driver of the extreme volatility. When hype runs far ahead of actual utility growth, it's often a sign of a speculative bubble.
Is crypto becoming more tied to the traditional economy?
Increasingly so, yes. It doesn't exist in isolation. Inflation is a big one. The narrative of Bitcoin as an inflation hedge drives demand, rightly or wrongly. Interest rates impact risk appetite. Globally, lower rates tend to push investors towards riskier assets like crypto, while higher rates can pull money away. Global stability matters. During crises or geopolitical uncertainty, some people look to decentralized assets as potential alternatives, especially if trust in traditional systems falters. And monetary policy indirectly affects crypto through its impact on inflation, rates, and economic growth.
So crypto markets are quite vulnerable to these broader shifts.
Very much so. The mix of sentiment, speculation, and macro factors, all turbocharged by social media and 247 trading, makes crypto prone to sudden, sharp swings, bubbles, and crashes that might seem detached from underlying fundamentals in the short term. That inflation hedge idea is potent, but its actual effectiveness is debated and relies heavily on belief. And as institutions get more involved and products like Bitcoin ETFs launch, the correlation with traditional markets grows, meaning global shocks hit crypto harder too.
For proof-of-work coins, you mentioned the cost of production. How does that factor into value?
For PAW coins like Bitcoin, some argue the cost to mine a new coin, primarily electricity and hardware depreciation, acts as a kind of floor or influences the price, similar to commodities like gold or oil. The idea is that miners won't operate long-term if the price is significantly below their production cost.
So if the price drops too low, miners switch off.
Potentially, yes. If the price stays below the marginal cost of production for too long, less efficient miners become unprofitable and might shut down. This reduces the network's total computing power, hash rate, which could, in theory, make it less secure. This perceived reduction in security might further depress the price.
But doesn't the mining difficulty adjust? And the supply is fixed anyway.
Exactly. The difficulty adjusts to target a consistent block creation time, regardless of hash rate. And unlike commodities, a higher price doesn't magically increase the supply rate of new Bitcoins. That's fixed by the code. So while production cost is a real economic factor for miners, the price is still primarily driven by supply-demand dynamics and sentiment. Cost is relevant mainly because a sustained period of price below cost could impact network security perceptions. Also, the fact that costs vary globally leads to mining concentrating in certain areas, raising those decentralization questions again.
Let's talk about the digital gold narrative. It's incredibly powerful for Bitcoin. How does Bitcoin actually stack up against physical gold as a store of value, based on the sources?
Right. This narrative positions Bitcoin as the modern digital equivalent of gold, which has served as a store of value for centuries. A good store of value generally needs qualities like durability, portability, fungibility, interchangeability, divisibility, scarcity, verifiability, and broad acceptance or trust.
Gold clearly has a long track record on those.
It does. Gold is physical, lasts forever, is recognized globally, relatively scarce, new supplies mined slowly, has non-monetary uses in jewelry and industry, and is traditionally seen as a safe haven asset during turmoil. It's also much less volatile than Bitcoin, typically.
And the argument for Bitcoin having similar but digital properties.
Proponents point to its scarcity. That hard cap of 21 million coins, enforced by code, arguably makes it more predictably scarce than gold. Its digital nature makes it extremely portable. You can send value across the world in minutes. It's highly divisible, down to tiny fractions. It's largely fungible, though the blockchain history adds a wrinkle. Verifiability is handled by the transparent public ledger. And acceptance is growing, especially among younger investors and some institutions, attracted by its decentralization and potential separation from government monetary policy.
But what are the key weaknesses or challenges for Bitcoin compared to gold in this role?
The sources consistently highlight the massive volatility. Bitcoin's price swings are many times greater than gold's, which really undermines its use as a stable, short-term store of value. It has a very short history just since 2009 compared to millennia for gold. Its resilience through truly diverse, long-term economic cycles is unknown. Regulatory uncertainty is a major risk factor for Bitcoin that gold doesn't face. It lacks widespread mainstream use for everyday payments. And it faces unique technological risks theft via hacking or key compromise, software bugs, the long-term quantum computing threat, which are different from the risks of holding physical gold.
So digital advantages like portability, but also digital risks, much higher volatility, and a far shorter track record.
That's a good summary. The comparison highlights trade-offs. Algorithmic versus natural scarcity, digital versus physical portability, high versus low volatility, short versus long history, evolving versus established regulation. The digital gold narrative is compelling and clearly drives demand, but Bitcoin's store of value status relies much more heavily on continued belief, adoption, and network effects than gold, which has intrinsic uses and deep cultural roots. The environmental debate around powder view mining is also a factor gold doesn't share in the same way.
This leads nicely into the final value point, the intrinsic value debate. Do cryptocurrencies actually have any inherent worth?
This is probably the most philosophical and contested area. Intrinsic value traditionally implies some fundamental worth independent of market price, often tied to physical assets, cash flows, or tangible utility.
And the argument against crypto having intrinsic value in that traditional sense
Is strong by those definitions. Cryptos aren't backed by physical commodities. They don't represent ownership in a company generating profits or dividends like stocks. They don't offer fixed income payments like bonds. They lack a sovereign guarantee like fiat currency. You'll hear central bankers or traditional economists state they have no intrinsic value, warning investors they could lose everything. Some argue the value is purely subjective, it's worth only what the next person will pay. And the reliance on converting back to fiat to realize value is sometimes cited as evidence its value is derived.
But what about all the factors we just discussed? Scarcity, utility, network effects. Don't those contribute some kind of fundamental worth?
They absolutely do, and this is where the debate gets tricky, maybe even semantic. If you define intrinsic value very narrowly based only on physical backing or cash flows, then most cryptos fail that test. But if you broaden the definition to include things like mathematically enforced scarcity, the tangible utility of using the network, for example, paying for computations, accessing services, the value derived from the network effect of having many users and developers, and the security provided by the underlying cryptography and consensus, then you can argue there is a form of fundamental worth. It just doesn't fit the old models perfectly. Its value is tied to the technology and the ecosystem built around it.
So it forces us to rethink what fundamental value even means for purely digital assets.
Exactly. It challenges the old frameworks. And ultimately, regardless of the academic definition, market perception, regulation, and institutional adoption play huge roles in establishing legitimacy and influencing value in the real world.
Okay, we've covered a massive amount. How they work, where they come from, their potential impact, the complex value question. Let's wrap up by looking at the major challenges still facing this space and the general outlook for the future.
Right. Consolidating some key themes. A huge ongoing challenge is volatility and investor risk. Those wild price swings, driven by speculation and sentiment, make crypto inherently risky for investors. Assessing that risk is hard. And as we noted, this volatility hinders adoption for payments and raises concerns about wider financial stability as links to TradFi grow.
Security threats also seem relentless.
Constantly. The underlying tech might be secure, but the ecosystem around it, exchanges, wallets, DeFi protocols, users themselves are constant targets. Hacking of platforms, phishing scams, tricking users out of keys, malware, fake projects, rug pulls, Ponzi schemes. The list is long and billions have been lost.
And those losses are usually permanent.
Typically, yes. Irreversible transactions, no central authority for recourse, no deposit insurance like in banking. It puts a huge burden on users to protect themselves and definitely erodes trust, slowing down mainstream adoption. Security improvements and user education are absolutely vital.
Regulatory scrutiny and uncertainty also casts a long shadow.
It's a major factor globally. The landscape is fragmented, rules are still being written, and there's fundamental disagreement on how to even classify these assets. Are they currencies, commodities, securities? Regulators are worried about consumer protection, money laundering, market manipulation, financial stability, taxation, and especially the risks around stablecoins.
And this lack of clarity holds things back.
Significantly, it makes institutions hesitant, stifles innovation because developers fear retroactive rule changes, and leads to companies shopping for friendly jurisdictions. Getting the balance right between allowing innovation and managing risks is the key challenge for regulators worldwide. A lack of global coordination is a major hurdle.
We also discussed scalability and the trilemma as a core technical challenge.
Yes. Many blockchains, especially older ones, struggle to process a high volume of transactions quickly and cheaply without sacrificing decentralization or security. Slow speeds and high fees during peak times are symptoms of this, making them impractical for widespread use cases like global payments compared to systems like Visa.
But solutions are being actively developed.
Definitely. Both Layer 1 solutions, which upgrade the base blockchain itself, like post-transition sharding, and Layer 2 solutions, which handle transactions off the main chain for speed and cost savings before settling back to Layer 1, like Lightning Network, rollups, sidechains. These are crucial for enabling crypto and dApps to scale to potentially billions of users. It's a very active area of innovation.
And finally, the environmental concerns, particularly around proof of work.
A very significant challenge that attracts a lot of negative attention. The massive energy consumption of POW mining and its associated carbon footprint are major issues, alongside concerns about e-waste from hardware.
What's the industry doing about it?
Several things. The big one is the shift towards the much more energy-efficient proof of stake. There's also a push for miners to use renewable energy sources. Developing more efficient hardware and code helps. Layer 2 solutions reduce the energy cost per transaction. And there's growing pressure for transparency around energy use. Sustainability is becoming a key issue for public perception and regulatory acceptance, especially with the rise of ESG investing.
So despite all these hurdles, the outlook seems to be one of continued innovation and growing integration.
That's the strong sense from the source material. It's a space defined by constant change and development, and we're seeing increasing bridges being built to traditional finance and other technologies.
What kind of developments might shape the near future?
Continued improvements in scalability via Layer 2s and refined consensus mechanisms are key for adoption. DeFi will likely mature, possibly becoming more user-friendly and potentially integrated with regulated finance if clarity emerges. Institutional adoption seems set to continue, with more regulated products and services. CBDCs will be a major development to watch, potentially competing with or complementing decentralized crypto. The role of crypto in Web3 and the metaverse as foundational infrastructure for digital identity and economies is another big trend. And overarching all of this is regulatory clarity progress here will hugely influence the pace and direction of growth.
Wow, okay, that really was a deep dive. We've gone from the absolute basics, decentralized ledgers, cryptography, how transactions work, mining, staking, all the way through the potential to disrupt finance, improve payments, boost inclusion, enable DeFi. We've wrestled with what gives crypto value, scarcity, utility, network effects, sentiment, digital gold, and faced the very real challenges: volatility, security risks, regulation, scaling, environmental impact.
It really highlights just how complex and dynamic this whole area is. What we've covered today, based on the sources, gives you a really solid grounding. But you have to remember this frontier is always moving. New ideas, new challenges pop up constantly.
And the goal, hopefully, is that this deep dive gives you, our listener, the context and understanding you need to make sense of the headlines, to think critically about crypto's potential role in the future, and just feel more informed about these digital assets that are clearly becoming more and more relevant.
Yeah, and a core theme running through the source material is that fundamental shift in trust, from relying on established institutions to potentially trusting technology, code, and distributed networks. But as the crypto world grows and inevitably interacts more with the traditional world, there's this constant tension between that decentralized ideal and the practical needs for structure, intermediaries, and regulation.
So maybe a final thought to leave you with, building on that tension. As this digital frontier continues to unfold, really consider, can trust in algorithms and code truly replace our long-standing trust in institutions in the long run? Or will the demands for structure, safety, and regulation ultimately reshape this decentralized vision into something perhaps quite different from its origins?